This episode is sponsored by our friends at YCharts. With all the various job functions that advisors are tasked with, your time is extremely valuable and often scarce. YCharts is a platform centered around efficiency and built with speed in mind. With an intuitive and user-friendly interface, YCharts helps save advisors 29 hours per month while uncovering better and new investment ideas. Need a way to help clients visualize their financial future, reinforce the importance of consistent investing, and guide them toward informed decisions? Tools for scenario building, portfolio construction, and proposal generation can be the missing piece to your service, so you can act on an idea right when the light bulb flicks on. Click the link in the show notes to start your YCharts trial for free and see how YCharts is a one-stop shop for growing AUM with fewer hours spent on investment management.
All right, hello and welcome to Yet Another Value Podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on for the first time, Steve Gorelik. Steve is a portfolio manager at Firebird. Is it just Firebird USA Value or is it Firebird overall? How do we say it?
So the firm is Firebird Management, and there's two kind of sides to what Firebird does. The traditional one, something we've been doing for 30 years at this point, is Eastern European investing. And that's kind of the beginning of Firebird Management. And then for the last 10 years or so, I've been running the Firebird U.S. Value Fund under the same umbrella, where we've taken the same fundamental part of what we do in Eastern Europe, which is focusing on cash flows, figuring out how companies make money, how companies spend money, and applying it to a different market we feel comfortable with.
Perfect. Well, we've got a U.S.-focused name to dive into today, but before we get there, same way I start every podcast, a disclaimer to remind everyone that nothing on this podcast is investing advice. Please consult a financial advisor, do your own work. Remember, nothing here is financial advice. Steve, the company we want to talk about today is a fascinating one. It is Akamai Technologies. The ticker for anyone listening is AKAM. And there's a lot to dig into, so let's jump right into it. I'll toss it over to you. What is Akamai and why are they so interesting?
Absolutely, and thank you for the opportunity to speak. So Akamai was started in the 90s as a CDN, which is a content delivery network business. The way that I would think about the content delivery networks is that this is a network of servers and ISP relationships around the world that allows content creators or websites, whatever you want to call it, so any kind of internet information, allows it to reach the final consumer quicker. So quite often this information is coming from one place and then has to be distributed around the world so the the consumers in Asia, Africa, Europe, US, wherever, get the information quicker, so you're reducing the latency by having the servers and the local relationships all over the world.
For listeners who are familiar with Netflix, like I remember, I think it was the book Netflix, one of the things they discovered was, if they stored everything in the central database out in Nevada, there'd be, 50 milliseconds of lag when you and I are loading up in New York City or Florida. And they discovered actually by putting the data on a closer local center to eliminate some of that lag, their viewership times, their customer retention, everything actually went up. And that's such a silly one because it's just streaming. But you can imagine, the company does video game leaderboards where that needs to be like up to the absolute millisecond. So you can imagine things where there's even better demand. But that's just a great example that always pops in my mind.
And that's exactly their top customers, companies like Netflix or the gaming companies. And then if you think about it, if it's Netflix where you're just downloading, okay, you're comfortable maybe with that initial delay, even though, as you're correctly pointing out, it's still uncomfortable. But if you're playing a video game and there's this latency between your action and what you actually see on the screen, that's a big problem from a point of view of user experience. So the CDNs are the companies that are making sure that user experience is better. They've been around since the late 90s. There's nothing particularly, and it is essentially a network of servers and ISP relationships around the world. Akamai was started out in the late 90s, I think in 1998. It probably has the best and the biggest network and standalone CDN, and this has been their bread and butter for the last 25 years. That said, this business for the last few years has been stable to declining. And part of the reason why that's happening is because, you have some competition emerge. And so there are other players that are CDNs that are providing a cheaper service that is not necessarily as good, but it's cheaper. And for certain class of customers, they're absolutely fine with it. But the other bigger issue for them.
Can you just provide an example of a competitor providing a cheaper, not as good service, and kind of what a not as good service would look like?
So Fastly is a good example of a smaller competitor, and the reason why they're not as good is probably because they have hundreds of services, not thousands, and hundreds of relationships and not thousands. So from the point of view of, I think they're a little more susceptible to things like DDoS attacks because you just don't have as much of a distribution. If you're looking for reliability, like reliability of service, I think the fact that Akamai has thousands of servers and this great of an infrastructure does make a difference. That said, if you are just simply hosting a website, you probably don't care as much. And so Akamai's product is more of a enterprise product and is more designed for kind of larger customers. They do have some of the smaller customers as well, but then if you go with somebody like Cloudflare or Fastly, which are kind of other CDNs, they will have more of an entry-level product that Akamai does not necessarily compete with.
You said enterprise, and I think that's right, but I also think it's a little bit performance, right? Like a lot of websites I know, because I know when they go down, it says, trying to connect to Cloudflare or something, like websites where 35 versus 50 milliseconds, who cares? Like a lot of them will go with that. But as you said, gaming, video, like especially streaming video, live streaming video, those types of things, probably going to go more with a performance product because milliseconds matter there. So sorry to interrupt.
No, you're absolutely right, and you're pointing out the right things. But the other problem that I've been facing in CDN from point of view of the customers for this, what they call this delivery segment, is that some of their largest customers, I think Netflix is one of them since you brought them up, have gotten big enough where that started making sense for them to invest into their own CDNs, to take at least a portion of the traffic that would normally go to Akamai and putting it onto their own network. So when we're talking about companies, obviously companies like AWS or Microsoft or Netflix, they now have a portion of the CDN they do on DIY basis. And that takes volume and revenue away from Akamai. So that's why if you look at Akamai's delivery segment, that's something that used to be growing at nice double-digit rates, but for the last few years has been declining. And that's really the dynamic that's happening there. And I would argue that that's the reason why the company is cheap, but that's not the reason why the company is interesting. Because at this point, delivery is only 40% of their revenues. And the other 60% is coming from two segments and two businesses that they've built on top of first of all, the network that they have, but also very importantly, the relationships that they have with the customers. And those two businesses is security segment. So we're talking about cybersecurity, and the more recent one being compute. So this is essentially the same thing, infrastructure as a service that you would get from AWS, Azure, Google Cloud, but with slightly different use cases, and also actually in part of it optimizing the edge network that they have, utilizing the edge network that they have. The security business, they started building out in mid-2010s, and it's kind of being built through a combination of acquisitions and organic growth. And what they seem to do is they seem to buy a high-quality company with certain capabilities that they want to add and to be able to cross-sell to their customers. And they usually buy these companies at multiples that may look expensive on price to sales basis, but once they plug in this product into their cybersecurity offering and able to cross-sell it to the customers that they have, there's a really rapid growth. So what they have, and the security business has grown to represent, I think, about 45% of their revenues. It's been growing by 20 to 25% per year. And this is something that they've built. Initially, it was I think like $400 million business back in 2016. Right now, it's $1.7 billion. And in order to build that from a point of view of the acquisitions that they have done through 2023, it doesn't include an acquisition I just made in 2024, but they spent probably about $2 billion on different acquisitions, and they've built a business with $1.7 billion of revenue. And if you take a look at security companies that are growing at similar pace and that are trading on standalone basis, those companies usually trade at 6 to 10 times revenue. So you kind of pick your number and kind of figure out what it's worth from a point of view of the valuation here. I think the reason why they're able to cross-sell, and I touched on it initially, is that they have, at this point, over 1,000 customers, enterprise, middle-sized businesses that are already paying over $75,000 per year to them for various kind of infrastructure services that they provide. It could be just the delivery business, the CDN business. It could be a combination of delivery and cybersecurity. But we're talking about a fairly large pool of customers where they're already talking to the decision makers, the CTOs and the CIOs. And it's relatively easy for them to go to the same decision makers and say, look, you're already getting great service from us on the CDNs. Let us add something to you that is actually fairly synergistic. So when you have a delivery business and you add to it a protection against DDoS attacks, it's very synergistic. It makes a lot of sense. So you can cross-sell that. And companies like Cloudflare, they can put it all together into one offering. Akamai conveniently, from our point of view as investors and consumers, they separate, so you can kind of see where that revenue is coming from. But you can see that this has been an effective cross-sell strategy. One example, yeah, go ahead.
No, go ahead. I thought you're probably, go ahead.
No, so one example of what they've done, because they've provided some data around it, is that they bought this company back in 21 called Gorelik, which is a zero trust security. So this is more like an authentication offering, and I apologize because I'm a generalist. So we're talking about technologies, I feel kind of out of place once we get deeper. But I do understand things like who you talk to within the company. I can understand the general market, and so they added the company, the Gorelik, that provides zero trust security. They bought it for $600 million back in 21. At the time of the acquisition, this was a company with about $30 million of revenue. Over the next 2 years, by cross-selling to their customers, they've grown it to a $100 million business. So you're talking about tripling. And they provided data on kind of what percent of their customers had zero trust security back in 22. So we can extract. So at that point, it was 12% of their customers. We can probably extrapolate it to about 20% right now. But if you take a look at some of their older security offerings, like the DDoS protection, those are being cross-sold to like 50 to 60%.
Let me hop into that example real quick, because this has a question I had towards the end, but I think since you laid out the numbers nicely, this is a great question. So one concern, and I think you can see this, again, you've studied this company a lot longer than I did, but I just read like the last earnings call and the last two, right. They go to a lot of conferences, so the last two conferences. But one concern people have is what they're paying. And even the company will say, hey, we pay big numbers. So let's use the numbers you just laid out, right? They buy a company for $450 million. That's got $30 million in revenue. And they grow it really quickly over the next 2 to 3 years to $100 million in revenue. I mean, that is operationally, that is a success. But as a shareholder, I'm just using the metrics you use, right? If I think security companies are worth 6 times revenue, right? 100 million in revenue today, 6 exit, it's worth 600 million. I paid 450 million 3 years ago. I can guarantee you that there was a lot of cash, a lot of stock comp and everything there. Like when I look at that, I say, hey, you guys paid a huge multiple. This went about as well as it could go, triple revenue in about 3 years. It went really well. And I'm looking at this, I'm saying, did we really create like a lot of value here? Does that make sense?
It does make sense, and it was 600 million. It wasn't 450 million. So you bring up a very good point. That said, if you look at total spending on acquisitions since 2014 in security, and I went through it and I tried to understand which ones are security, which one are not. But most of the acquisitions, aside from Linode, which was compute, that was mostly acquisitions in security. We're talking about total spending of $2.4 billion. At the end of 2023, this was a division with $1.7 billion of revenue. And margins, they don't show those margins specifically, but in their investor days, they say that the margins there are better than in the compute business. So now, if we're talking about spending $2.4 billion on creating a $1.7 billion revenue business that is growing at 20% per year. If we put a 6 to 10 multiple on that, did they create value?
And I think one of the things that's interesting here is, as you alluded to, like, this is call it a 15 billion EV company. If you put a 6x multiple on, as you said, they'll do about 2 billion in security revenue this year, growing 20%. You're kind of saying, hey, is the security business covering the entire, is the security business covering almost or the entire EV? Now, I think reasonable people could push back. 6x revenue is still a big multiple, 20% growth, a lot of things, but I think that's part of the interesting. Why don't we cover, if we're done with security for now, why don't we quickly go through cloud compute and then we can jump into some of the questions and everything?
Sure. So cloud compute, and I'll give you a little bit of background, kind of my history with that, with the company and with the cloud compute. I started looking at the company back in 2017. At that point, we didn't invest into it, but I started looking at it. And I talked to a fairly senior technical person at one of the gaming companies at the time about how they use the CDN business, so the delivery business. And he said a lot of good things about Akamai as a delivery network. But he said the thing that they're missing is compute. I would love for them to have compute, because especially for a company like gaming, where, and I think you alluded to it slightly earlier, where there is this need to do some computation on the edge in order to make things quicker. He said they were just missing that. And back in 21, and Akamai acquired a company called Linode, which was a relatively small infrastructure as a service, computational compute provider. And when they paid $900 million for it. When they acquired it, I think I need to check my numbers, but it wasn't a significant size company. This was, I think, they had about $200 million of revenue. So they paid a fairly sizable multiple on sales there. But the idea there is exactly the same as what they have done successfully, I would argue, in the security, is that they're adding a third leg to the stool, selling services that their customers want and need, selling services to the same type of customers that they're already talking to. And they've built another leg to the business that they're going to be able to grow at 20% plus for the foreseeable future. The idea of the compute business is that they want to participate in the cloud computing, which is right now a $200 billion business. They're saying that within that, yes, obviously there's hyperscalers, there AWS, Google, etc. And they will be the vast majority of that business. And they need to be, and they have the infrastructure to do that. But they're not going to be all of it. And there are certain use cases in which a distributed, still cloud network, but distributed on the edge servers around the world actually makes some sense. One example we talked about is in gaming, because you already have, you brought it up yourself as far as when you're talking about the immediate response, when you're talking about leaderboards, gaming leaderboards, those can and should be done on the edge. Another example is Internet of Things. So all of the devices, when we're talking about the IoT devices around the world, those computations are not necessarily the most difficult ones. When you're doing a difficult scalable computation, that's where you really want to go with somebody like AWS, because they do have the scale. But for the simpler computation where speed and location matters, edge network makes a lot of sense. Another place where edge network makes a lot of sense is when you're doing the computation on data that really can't leave where it is. So when something is, so I'm in UK right now, but when you're dealing with something that is like, where you have to be GDPR compliant, healthcare data, quite often cannot leave the country. So once again, you want to be able to do the compute on location. And this is not something that now Akamai can provide to their clients, the clients that they already have.
This episode is sponsored by our friends at YCharts. With all the various job functions that advisors are tasked with, your time is extremely valuable and often scarce. YCharts is a platform centered around efficiency and built with speed in mind. With an intuitive and user-friendly interface, YCharts helps save advisors 29 hours per month while uncovering better and new investment ideas. Need a way to help clients visualize their financial future, reinforce the importance of consistent investing, and guide them toward informed decisions? Tools for scenario building, portfolio construction, and proposal generation can be the missing piece to your service, so you can act on an idea right when the light bulb flicks on. Click the link in the show notes to start your YCharts trial for free and see how YCharts is a one-stop shop for growing AUM with fewer hours spent on investment management.
Let me just a quick question on the cloud compute strategy, because that does sound interesting, right? You've got these clients, you're at the edge, you've already got them, and then you just sell, hey, we can do this compute right at the edge for you, right? That sounds interesting. And I think they're obviously, like, this is an hour-long podcast, 3 division, we can't cover everything. But one strategic question that jumps to my mind is, hey, the core business, the legacy business here, we started this podcast off by talking about how it's declining. And a lot of the reason it's declining is because these large customers, your Netflix of the world, are going and building their own locations right at the right at the site. So I think kind of a natural question is, hey, if the core business is declining and you're going to your customers and saying, hey, we've got this delivery business, we're already with you, let us do your cloud compute at the edge. Are you trying to sell like a growth market with a unique thing into a lot of customers who are already pulling spend away? Does that make sense?
It does make sense, but the customers, I would say that customers is pulling spend away, but they're spreading the spend. So in a way that, so if you have somebody like Netflix, it does make sense for them to take on some of the data volume that is going through and putting it onto their own servers. It doesn't mean that they stopped using Akamai completely. It's just it's no longer, and I don't think it ever was 100%, because you never want to use just one CDN. You want diversity. So, but they have a lower market share of this customer, but they still deal with this customer on a daily basis. So you still have the window into that customer, and you can still talk to them, and providing them a compute solution. Once again, it's more often than not, people are going to multi-cloud solutions. And we didn't talk about it yet, but the solution from Akamai and from other people like DigitalOcean is quite often cheaper than it is from the large cloud providers like the AWS or Google. And part of the reason why it is cheaper is because you don't have the ability for that unlimited scale that exists with AWS, but most people don't need it. And more often, and quite often, that has gotten people into trouble. Like my wife she's a VP of software engineering, so kind of like I hear stories through her about it. And there are more and more people just realizing that they run a query overnight and then they wake up to a $50,000 AWS bill.
I remember, especially when AWS first came up. Let me ask, I have two questions I want to ask there. First, cheaper. That's a little bit surprising to me that, an AWS or a Google wouldn't be cheaper than this, because, you think about AWS and Google, like they have such huge scale. I would think they would be the cheapest for most base loads, and then like an Akamai or a smaller person would actually be more expensive, but they would be more specialized. So you would get, whether it's more hand holding or more custom cloud compute. I'm just a little surprised to hear, or because they're closer to edge, you get a lower latency. I'm a little surprised to hear that they're cheaper. So why are they cheaper?
So I was trying to figure this out as well. It's a very good question. And so one area where there is significant cost savings is that somebody like Google or Amazon, whenever they have the relationships with the ISPs, so kind of like that final leg, the final mile of data either coming in or coming out, they are not necessarily price sensitive because they want to have as much allocation as possible, and they're paying up for it. And when they're paying up for it, they are then passing the cost of that to the customers because they can. And you as a customer, if you need to put terabytes of data very quickly, you can. You cannot do that with somebody like DigitalOcean or Linode or Akamai. There is some scalability that doesn't exist, but you're trading off that for a lower price.
So you're trading off unlimited scale optionality for a low price. Okay, that makes
Yeah,
one more
and
question on
think,
delivery.
Think about it like if you need an Uber and it's just you and you have an options and you can get an Uber XL, you can get a regular Uber, you can get Uber with a car seat, with a baby car seat. They have different prices. And if you have a baby, you need one thing, but if you don't need to pay for it.
Yep. One more question on delivery, and then I want to go to back up and go to some higher level questions. When a Netflix takes, and I just use Netflix as just a great example, everyone knows it. When they decide to take a little bit of the delivery business in-house, right? Is this a case where they're saying, hey, New York, Seattle, Los Angeles, these huge markets, there's enough scale there where we can build our own internal solution there, but Montana, right? We're not going to go build our internal solution in Montana, and maybe there, because there's not enough scale and not enough people, it still makes sense to outsource and let Akamai roll up Netflix, EA Sports, and 500 other companies and put that in. Is that more what's happening with the delivery, or would a Netflix be like, we're large enough, we've got enough data, let's just go direct everywhere we can? That question make sense?
And that's my understanding as well. So that's where you will have, Akamai has, I think they say something like 4,000 servers around the world. Some of them are in New York, some of them are in Montana. And and this is exactly it. So where Netflix, when it knows that it has a few 100,000, if not millions, customers in New York, and they know how much they use the data, they know that they can put some of their own hardware and save money. Akamai is we didn't talk about it, but Akamai is a very profitable business where they have their contribution margin the cash contribution margin is like 75%. So, and the overall profitability is very strong as well. So it's a premium product. And if you can do some of this in-house reliably, you will. But it's only an option for Netflix, for EA Sports, maybe. It's not an option for somebody if you have a website that has a few million customers. Like we talk it's like the top 5-10 customers, and they're big, have that option, but the 100th largest customer probably doesn't, because the infrastructure the money that you need to spend is significant.
Does it ever stop being a declining business and go back to growth again? Because I could see a scenario where like the 100 largest internet companies are so big and so large that eventually they do a lot direct. But honestly, I'm kind of surprised, like the long tail of the internet, it continues even while the big get bigger, like the long tail of the internet grows so much. I could see an area where a future where the long tail just continues to get so big, eventually they start growing again. Or you could tell me, hey, like a worry would be the hyperscalers start offering some of this delivery on their own or something, just because they grow to be all encompassing.
So they do offer some. So somebody like AWS does offer their own CDN service as well, and that may make sense for some customers. The way that companies talking about it, that delivery is kind of zero growth business. They say like low decline to zero growth business, and that's how I'm thinking about it as well. Like it used to be a nicely growing business, like I already mentioned. For the last, I think, since 2019, the revenues have been declining. And I think that's what creates the opportunity in the stock, because people are uncertain how long it's going to decline. We had a fairly weak Q1. This is, company has gotten more interesting because they had their delivery revenues dropped 10% year over year. So people are really concerned. They attribute it to a couple of very specific factors, including one of them being they didn't name the company by name, but they said a social network company facing regulatory pressure. Kind of sounds like TikTok.
It does, but at this point, all the social networks face.
Right. But
let me back up a little bit. If we zoom out, right, the company, which was a .com bubble company, which it's fun to look at their stock chart because it starts with this enormous peak. I think it's like $350 per share in 1999 or something. And you and I are talking, and it's, the highest it's ever hit since then is like 120, 130. So that's kind of fun. But ignore the .com bubble beef. I think we can put 25 years behind us. If I zoom out, in 2015, this is a $70 stock. And that's kind of right when they start doing the security, going in security. 2021, it's a $120 stock. Like, 6 years, 70 to 120, not the end of the world, but not exactly the best returns ever. as you and I are talking today, June, what is it? Is June 4th, June 5th, June 6th, 2024. It's a $90 stock. And I guess what I'm asking is two things here. Why now? And the second thing I'm going to ask, which we could get into, is I kind of look at some of their commentary, and they go on these conference calls, they go on their earnings call, and they say, hey, we generate a lot of cash and we can do a lot of things with it. We can do some buybacks, we do some acquisitions, like we can do a lot of things. And that sounds great, right? It sounds like you've got a management team really focused on capital allocation. But one thing I worry about is a lot of the buybacks go to offsetting stock comp, and there is a lot of stock comp here. And I guess what I'm going to try to drive at is, I do kind of wonder, is this a business that's being run for the stockholders, or is this a growthy, sexy business that, it's nice to get some return, but it's really being run for the employees? I'm just looking at my numbers. 2023, 1.6 billion in adjusted EBITDA, 330 million in stock comp, and that actually ignores another 60 million of amortized stock comp that they'd exclude. Mm-hmm. So a lot of this is going to stock comp, and it's largely offsetting the buyback. So I did throw a ton at you. I'll just pause there and
right. Hear. And those are all very important points, and I'll try to address them one by one. If I forgot one, please bring me back. From the point of view of why now, and what's been happening to the company between, let's say, for the last 4 years or so, where the stock price has stagnated, is that you had back in 2019, 2/3 of the business was delivery. And since then, as we already discussed, that's been a declining business. Right now, we have a company where delivery is 40%. So at this point, it's already 60% that is I would argue, fast growing businesses that are growing at 20% or so per year. And you have 40% that is a declining business. Because of how the math works, over the last 4 or 5 years, you had a company that was delivering mid-single digits growth rates. So call it 3 to 5%. You had the dynamic of the declining delivery increase, and now the business is growing at 20% per year. From here, because delivery is smaller, even if it continues to decline at like 7% per year, and I think it's going to be a little less, but let's say 7% per year. And the other businesses grow at 20%, we now go into the high single digits, low double digit growth. And the multiples that the market pays for businesses that are growing at 10% are very different than the multiples that the market is paying for the businesses that are growing at 5%. And I think at this point, are actually very close to that inflection point where you're going to go from mid-single digits or low single digits to high single digits. And we never play for the multiple expansion, but you are in the conditions where multiple expansion can start happening. So that's one of the reasons for why now. As far as the stock comp is concerned, and I do the stock comp slightly differently, is what I try to figure out is how many shares they issue per year. And you can figure it out if you take a look at how many they're buying back and how many the net share change. So they do 2 to 3 million shares per year of issuance to the employees. And that's not insignificant. That's 2% of the company per year. But even if you take that dilution into account going forward, then let's keep it at the same, about 2% of the company per year. Given the amount of cash that they generate and the growth that they're generating in the free cash flow, I still think we as shareholders are reasonably well compensated. We also have, the CEO, who's the founder, he has a salary of $1 per year. And all of he's already a sizable shareholder. He has over $100 million worth of shares. And all of his comp is in shares as well. So from that point of view, I do think that we're more or less aligned.
If I can add on, so the CEO, sorry, I was just making sure I had pulled it up and right. Layden Thompson, one of the reasons for why now, when you say why now, is May 14th. We're speaking June 6th. So last quarter, right after earnings, May 14th, he makes an open market buy of $2 million worth of stock at, let's call it today's prices, right? And that alone would be interesting, especially getting paid $1 per year. He's doing $2 million worth, 2 million times his salary is the open market buy. But the other interesting thing here is, with open market buys, I think the buy is one thing, the size of the buy is one thing, but another good signal is what is the history of the open market buy here. And when you look at the history of open market buys, there was the general counsel bought 2 shares at 111 in 2021, so $200 worth of shares. We can probably ignore that. I think who knows what happened there. This is just what my rep says. But aside from that, there was not a single open buy since 2016, 2017. 2017, one VP buys 200,000. In 2016, the CEO buys $6 million worth of stock in the low 50s, right? So low 50s to, it's not the greatest return of all time, but 2021, as I mentioned, the stock was 120. So we had more than a double inside of about 6 years. That's actually a pretty nice return. But I'm just saying it because it's not like this is a CEO who buys a little bit on the open market every now and then. This was a sizable insider buy, and it was his personal first buy in almost 10 years. And I think the combination of those two, when I ask you why now, I think the CEO is kind of signaling he sees exactly what you're seeing, if that makes sense.
And I know you had Asif on your show recently, and it's one of the favorite things that he says, because I know he tracks a lot of the buybacks and like the insider transaction. And he says there's multiple reasons for why people will sell shares, and life gets in the way. But there's really only one reason why people buy shares.
I love that quote, and I generally agree with it, though I can't tell you how many times I've seen a CEO who gets paid, $500,000 per year, and he's been there for 6 years, and the stock is down 70%, and he goes and he buys 50,000 on the open market, which I'm kind of like,
right, but different. We're talking different magnitude.
Yeah, but people say one reason, and I think there's like maybe 4 reasons, but in this case, I think that quote certainly applies. Let me go to a different one that I think our listeners will be interested in. One of the tough things for me, because I'm with you, I'm a generalist. One of the tough things for me, a lot of people want me to look at, I spend a lot of time in cable. A lot of people want me to look at like enterprise fiber or the B2B telecom. And whenever I look at them, I'm like, look, I understand the story. I get what you're seeing. I want to get here, but I just worry. I'm a generalist. I worry that there's people, and I can't tell you how many times there's been this sexy fiber, dark fiber, B2B play where all the customers have all of a sudden fled. You said earlier, I'm a generalist. And I think a question would be, hey, Steve, you are competing like security is one of the hottest, toughest, most money going into its space. Cloud computing, it sounds great, huge growth industry, but you're competing with AWS, you're competing with Google, you're competing with all these startups that are coming in. I think people might just say, hey, like Steve, Andrew, me as a random listener, why are you guys the ones to look at this and say, it's cheap, it's hitting that inflection point, but we really understand the strategy, and we're not going to wake up to, 6 months from now, hey, all of our cloud computing customers are going with the largest, or they're going with this hot startup or something. Does that question make sense?
It does make a lot of sense, and you would be stupid if you're not asking that question. But the thing about it is that I think as a generalist, we have plenty of disadvantages that you just named. But the advantage that we have is having the ability to take a look and having the mental models that are applicable, the things that we've seen in different industries, and apply them to other industries as well. So this is a kind of a different example, but in the past, one of the most successful investments that we've had in the past was in this company called Arista Networks. And Arista Network is it's a really, really kind of successful company recently because they've been growing at 20% per year, but they had this, and they make switches that go into the data centers, and it used to be growing at 20% per year, and then it had a period of about a year and a half where the growth stopped. And the share price went down, if I remember correctly, by 60 or 70%. And the reason why the growth stopped was not because they didn't have the right product, but because their major customers, the Metas of the world, the AWS of the world, were going through the period where they were designing the next generation of data centers. And there was a lull in purchasing of materials that they needed for those data centers. But at the same time, if you read the company transcripts, they said, we are with those customers participating in the design of the next generation of data centers. And I, as a generalist, I can understand the relationship between a customer and a supplier. because I've seen it in many different industries. So one of the things that we're looking for is we're looking for the companies that make the whole ecosystem better. They take a rent on it, but they make the whole ecosystem better. If the customers benefit, if the suppliers benefit, and you as a company can benefit from kind of spreading that wealth around the world. And I think, and then what happened with Arista is that once you went through that lull, and the purchasing for data centers has restarted, and the growth rate has restarted at 20% and actually accelerated recently because of the excitement about machine learning and artificial intelligence. Well, the multiples went back to where they were before and even expanded further. And so I think it's not the same thing here, but once again, I think this is a company where what I'm betting on is that they have relationships, valuable relationships with thousands of customers that know the company well, that believe that they provide a good quality product. And the salespeople from Akamai have the foot in the door and the relationships to be able to come in and say, guys, we have the right security product for you as well. We have the right compute product for you as well. Compute is a $200 billion market growing at 15 to 20% per year. If what Akamai says is that, like, if we get 2% of that, well, 1%, forget 2%, 1% of that, that's a $2 billion revenues for them. And we're talking about a company with current revenues of what, about almost 4 billion. So like, just like from a scale, but magnitude of what it could mean, like we have a lot of ways. Like I think the risk reward is in our favor. That's all I'm trying to say.
I hear what you're saying, though. You know, the old if we can only capture 1% of the TAM is tough. But I really like what you're saying on the general side, because one of the things, it was Chris Pabisi, I think he was pitching, it was AVTR on the podcast. And one of the things that I've learned this year that just really stuck with me is he was talking about, this is a life sciences company. He said, look, I asked him a similar question. Mm-hmm. Why can you as a generalist outperform? They're a life sciences specialist. All they do is this. And he said, if you're a life science person, you've literally never seen cyclicality before, right? You've never seen the inventory bullwhip. Whereas if you're a generalist, you've seen inventory bullwhips, not in life sciences, but you've seen them in memory cards. You've seen them in oil and gas. You've seen it everywhere. Mm-hmm. The industry is going through an inventory bullwhip, and these specialists have no clue how to handle it, how to think about it. And a generalist can apply that and make money here. And what you're saying with Akamai, I love the story you just told, because it makes sense to me, right? Where you've got this sales force, they've got a pretty sticky product, they've got their fingers into a lot of different clients, and it's a cross sell. Now, the counter to that is, as you know, with everything, these are competitive spaces. Industry is very difficult. Everybody's trying to cross sell everything, but you've kind of got some of the proof already where, as you mentioned, they've spent $2.4 billion scaling up the security side, and they've grown it into a $2 billion-ish revenue company growing 20% per year. You want to say anything else on that?
So in terms of security, and kind of going back to the point of 1%, 2%, et cetera, I was trying to find data on the global cybersecurity market. I think it was about 30 billion back in 2016. It's around 80 billion right now. If you take a look at the revenues that Akamai has in cybersecurity, they had a 1% market share back in 2016, and they have a 2.3% market share today from those numbers. So when they're talking about getting to 1% market share of compute, I don't think that's a ridiculous statement.
I don't disagree. One thing I do wish they did is, I wish they gave out organic. I know it's difficult when you're cross-selling everything, but I do wish they gave out a little bit of organic, because maybe they have at some point, but as I was prepping for the podcast, I went through like the last earnings call and two conferences in decent depth, and then I kind of flipped through some of the other ones and I went through their disclosures. They don't give any organic growth breakout, and it's just, as a generalist, as somebody who's a little skeptical, I just really wish they did, because they are buying stuff all the time, and not huge deals. Most of these are bolt-ons, even if they're big dollar figures, but I just wish they would give us a little bit more organic, so I could go to listeners and say, hey, they're going to grow 20% in security this year, and 19.5% is organic or something. I don't know if you've got better.
I think what we talked about earlier in terms of the high multiple to revenue that they're paying for the acquisitions suggests that most of the growth is organic.
Very true. Very true. Yeah. But it still just would be nice to get a little bit more, sunshine is the best disinfectant. Switch to something a little bit more fun. I've got the quote if you don't have it, but you could see a lot of ways this company could be an AI play, right? A lot of different ways. And I'll just turn it over to you. If you don't hit the quote that the CEO gave at a recent conference, I'm going to give it. But I don't know if you know this one or not. It's no big deal. It was just
I don't think I do, so I would love to hear it. So
somebody, a analyst asked, "Hey, is AI good for you? Like, would you guys be an AI beneficiary?" And he said, "Look, we do everything on the edge. If people start wearing goggles, AI goggles all day, it's going to be really gosh darn good for us." And that quote, when I read it, just made me absolutely crack up. But ignoring that, tongue-in-cheekness aside, you could see a lot of ways this could benefit of an AI play. It obviously hasn't caught an AI multiple, but AI is hot. A lot of stuff is going into LLM investments, everything else. I just want to ask, do you see any AI upside, or do you bake any of that into your thought process here?
So for the time being, I think the company is making a conscious choice not to invest into some. And when we're talking about the compute part, so this is one of the major areas of investment for them. It seems like for the time being, they're making a choice of not to invest a lot into GPUs. And I think the reason why they're not investing a lot into the GPUs, because they figured that that's something that they can get to when the time is right. And so one of the metrics that they're giving on the investment, on the compute side, is that $1 of revenue growth requires $1 of capex. The returns on it are actually pretty good because you have about 80% gross margins, about 40% net margins. So you're getting good return on that, but it's 1-to-1 ratio. If you look at DigitalOcean, which is taking so they are a compute provider, and it's an interesting, if you are looking at Akamai, I would strongly encourage to look at Cloudflare and to Fastly and to DigitalOcean, just to understand the other companies in the space that do provide a lot of useful information. They're spending 1/3 of their capex this year on GPUs. But what they're saying is that for $1 of capex, they're going to get 50 cents of revenue. Because NVIDIA has a $3 trillion market cap. They can charge whatever they want for the H100 chip or whatever this next generation. They can charge whatever they want, and people will pay it today. And there's going to be other people that will pay for access to those chips through the infrastructure as a service. But those end users right now, very few of them are making money. That's a completely different conversation that we're not going to get to today. So from the point of view of whether that company that is actually trying to build an LLM will be able to make money and will continue to pay the amount of money that's required to the DigitalOcean or to AWS to access those chips, to access that capability, that's a question mark. But you can always build that capability a year or two down the road. Yes, you're not going to get the revenue today, but you're not getting the returns today either. So I don't think that Akamai is missing anything by not having that infrastructure today. Because they already have the servers and they have the customer relationships, I think that they're going to invest into it when the time is right and when the returns are right.
This episode is sponsored by our friends at YCharts. With all the various job functions that advisors are tasked with, your time is extremely valuable and often scarce. YCharts is a platform centered around efficiency and built with speed in mind. With an intuitive and user-friendly interface, YCharts helps save advisors 29 hours per month while uncovering better and new investment ideas. Need a way to help clients visualize their financial future, reinforce the importance of consistent investing, and guide them toward informed decisions? Tools for scenario building, portfolio construction, and proposal generation can be the missing piece to your service, so you can act on an idea right when the light bulb flicks on. Click the link in the show notes to start your YCharts trial for free and see how YCharts is a one-stop shop for growing AUM with fewer hours spent on investment management.
I am not familiar enough with their assets to say it, but I will just throw it out to you and you can wordsmith, correct anything I missed. But the other thing is there is this enormous rush for data centers that can with power access. And I would have to imagine if the crunch gets bad enough, you're looking at Akamai with a billion-dollar cloud compute business. If the crunch got bad enough, even if they had absolutely zero AI exposure, I just think buying all that server and all that access to power alone would make them kind of an AI play, if that makes any sense whatsoever.
It makes sense. And I think what you're identifying is different ways that we can win with this investment. Our starting point, and kind of going back to what I was talking about in the beginning, where kind of how do we look at companies, which is what do we pay for it? Our starting point is a 6% free cash flow yield. Yes, that includes some of the money. Obviously, that's free cash flow from operations. So that includes the money that you have to offset the comp. But our starting point is 6% free cash flow yield. I think we have a company that is growing at high single digits, low double digits for the foreseeable future, even without the things that you just talked about. I think we're okay even without multiple expansion. We should be able to get returns in mid-teens without multiple expansion, assuming multiple doesn't shrink and assuming the company delivers. Two big assumptions, but it is what it is. But this company is trading at half of the multiple and not less of the companies that do have the AI fever to it or the cybersecurity or whatever it is. So if we have that multiple expansion, which is actually what happened with Arista Networks, you get very different return.
Let me ask you one last question here, and then I unfortunately have a hard stop at 10, so we'll probably have to get close to wrapping up. But I think you've detailed all the ways the Salesforce synergies and everything we talked about, why these three different segments belong together. But another question is, do these segments belong together, right? Because I do hear the Salesforce synergies and everything, but I've got a high growth cloud compute business, a high growth security business. I know like Amazon offers, Microsoft offers the combination, but most players are kind of going at it's such fast growth and it's so specialized. Most players are kind of focused on just one area. And even ignore that, marrying those two to the delivery business, which is it should probably be run as a cash cow. Marrying those three is a unique combination. I could see the synergies there, but I could also come to you and say, Steve, like, we've got one business that's about 40% of our earnings. That should be a cash cow. We should be levering that up and we should just be returning capital. We've got the security business, a lot of stock comp, a lot of highly paid engineers. We should be, pedal to the metal, going for it, stock for stock, M&A, all sorts of things, cloud compute, kind of similar. Do these businesses belong together in your mind?
In my mind, they do. Because what you are providing, especially when edge, so the delivery and the compute, you can combine those two with an idea of infrastructure as a service. All what you're providing in both cases is internet infrastructure for people that need it. It could be just infrastructure to deliver. It could be infrastructure for you to be able to do scale computing on a size that you cannot do on your own location. But it is the same to me and also has a similar customer base, as we have discussed. Security, once you take into account that you already have the edge and the delivery to the edge, security is super important there because that's where the attacks happen. The attacks happen on the edge. So if you can do the DDoS, you can stop the DDoS attack by using that network that you have. And by spreading the DDoS attack, that's exactly what it's there for. Web authentication is much better on the edge than it is in the middle. Because even if somebody gets through, you have another layer of security there. So from that point of view, and I think from a customer point of view, it actually makes sense to be talking to the same company if they, and that's a big if they can provide a good enough service or the best service in each one of these things, why wouldn't you buy it from them? If they don't, and that's the problem with a lot of these large companies that are trying to do everything, is that if they cannot provide a good enough service, then they have no business of being there. But looking at how effective the Salesforce has been at cross-selling these services, it seems like they are providing value for the customers.
Perfect. Again, I have a hard stop at 10, so we're going to have to cover it. I'm impressed with how much we got through. I'm looking through my notes, and I think we got through everything. So I just want to turn it over to you before we wrap it up. I think we did a really nice job of covering everything, but is there anything you wish we had kind of talked about that we didn't manage to get into?
No, I think we covered quite a bit, and I really appreciate your questions and you doing this podcast. I think we as an investor community benefit from the questions that you ask and from the light that you're shining on the companies. Really appreciate the opportunity. Happy to follow up with anyone who's interested to talk about this or any other things, either in the US or in Eastern Europe. I know you posted this on Twitter and you immediately got a question about Bank of Georgia, so it's a completely different conversation and we're not going to get to it within 5 minutes. But I'm on Twitter or X, whatever you want to call it. We're at our website is www.fbird.com. So if you're always happy to reach us through that. And thank you so much for the time.
No, I'm just laughing because, when I announce these on Twitter/X and I tag you and you're just a blank face on Twitter. And then, as you said, the first response is Bank of Georgia. So I try not to check Twitter too much, though I end up checking it quite a bit. And I'm like, Bank of Georgia? What? Am I doing a bank podcast? Am I just like in such a haze? I can't remember everything, but this was great. fbird.com if you want to follow up with Steve. Steve, this has been awesome. And the unfortunate thing for you is I've got your Q1 letter and there's 2 companies I'm interested in there. So we'll have to do a follow-up in the near future, but really appreciate you coming on and we will chat soon.
Sounds good. Thank you, Andrew.
A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.